December 17, 2025. An explosion no one expected. While you are reading these lines, something incredible is happening on Wall Street. Shares of Albemarle Corporation, NYSE ALB, are soaring by 4.55% in one day. The price is $140.48, a fresh 52-week high. UBS upgraded the rating from neutral to buy and raised the target price from $107 to $185. Morgan Stanley raised the rating to equal weight with a target price of $147. Deutsche Bank raised the target to $125, Citigroup to $150, Mizuho to $132. Analysts are speaking with one voice. We were wrong. But let us rewind. How did the largest lithium producer in the world end up at the bottom? In June 2022, Albemarle shares were trading at $300 per share. The lithium market was on fire. Lithium prices reached $77,000 per ton. Everyone was shouting that lithium was the new oil. In April 2025, the shares fell to $49.43, a loss of 83.5% of value. What happened? A temporary lithium surplus. In 2023 and 2024, producers, blinded by the high prices of 2022, ramped up production. Around 40% of global capacity was operating at the edge of profitability or at a loss, and about one-third of it was shut down. Prices collapsed from $77,000 to $8,259 per ton by June 2025, a drop of 89%. Investors fled in panic. Analysts cut ratings. Hedge funds reduced positions. Everyone saw a cyclical downturn. No one saw what was happening beneath the surface. By December 2025, the reversal arrived. Lithium surged again. In June 2025, $8,259 per ton. In December 2025, $13,003 per ton, a growth of 57% in 5 months. Chinese futures were above 92,000 yuan, $12,800. Why did this happen? Morgan Stanley pointed to a lithium deficit due to high demand for energy storage systems. Lithium demand is expected to grow by 15% in 2026. China introduced export restrictions on advanced battery technologies. Mines around the world closed. Supply evaporated. The market turned. And Albemarle was the first to benefit. Why Albemarle and not competitors? Let us be honest. As of April 2025, Albemarle was the fourth largest lithium producer, behind Rio Tinto, SQM, and Ganfeng Lithium. But this is what changes the game. Albemarle has the lowest production costs in the industry. The company owns the best deposits in the world. Salar de Atacama in Chile, the largest and cheapest deposit. Greenbushes in Australia, a joint venture with Tianqi, the largest hard rock mine. Silver Peak in Nevada, United States, the only operating mine in the country. When lithium prices fell to $8,000 to $9,000 per ton, 40% of global capacity was operating at a loss. Albemarle continued to earn money. Albemarle is vertically integrated. It is not just a mine, it is a full chain. Lithium extraction from brine and hard rock, processing into lithium carbonate and lithium hydroxide, direct supply to battery manufacturers. Competitors buy spodumene concentrate from third parties. Albemarle controls the entire chain, which means more margin. Albemarle has contracts with giants. Its clients include Tesla, the largest electric vehicle manufacturer, BMW and Volkswagen, European leaders, LG Chem and Samsung SDI, battery titans, CATL, with 37% of the global battery market. When lithium becomes more expensive, all of these giants pay Albemarle more. The main thesis is simple. The market punished Albemarle for the cyclical downturn of 2024 and 2025. But cycles in lithium last 2 to 3 years. Structural demand will triple by 2030. Albemarle is the lowest cost producer. The current price of $140 versus a potential of $250 to $300 within 3 years. Quarter 3, 2025. Results that shocked Wall Street. On November 5, 2025, Albemarle published its results for the third quarter. Analysts were expecting a disaster. Wall Street expectations were earnings per share minus 0.90 and revenue $1.276 billion sign. The reality was earnings per share minus 0.19, a beat of 78.89% revenue, $1.3 billion sign, and adjusted EBITDA $226 million sign, a growth of 7% year over year. The shares jumped 3.97%. How was this possible with cheap lithium? The first secret was extreme cost reduction. While competitors were panicking, Albemarle optimized everything. The company shut down unprofitable capacity, reducing Kemerton from 50,000 to 25,000 tons per year. Capital expenditures were cut from $1.337 billion sign to $434 million sign over 9 months. The project in South Carolina was frozen and funds were redirected to Kings Mountain. Non-core assets were sold, including Ketjen and the Eurocat joint venture, for $660 million sign. The result was positive free cash flow of $300 to $400 million sign for 2025. The second secret was record production volumes. The paradox was that prices fell, but volumes increased. There was record production in the third quarter of 2025. The energy storage segment grew by 8% despite falling prices. The strategy was to capture market share while competitors were weak. When prices surge, margins will explode. The third secret was energy storage as the hidden driver. Everyone thinks Albemarle equals electric vehicles, but the reality is different. Energy storage is growing faster. Electric vehicles are growing by about 20% per year, while energy storage is growing by 30 to 40% per year. The drivers are solar and wind energy requiring storage, data centers for artificial intelligence needing backup power, and modernization of power grids. Morgan Stanley expects lithium demand to grow by 15% in 2026, mainly due to energy storage. The fourth secret was margins like Apple. At today's price of $13,000 sign per ton, costs are around $7,000 to $8,000 sign, with margins of 38 to 46%. At $20,000 sign per ton, the 2026 forecast, margins rise to 60 to 65%. At $25,000 sign per ton in a bullish scenario, margins reach 68 to 72%. This is the level of software companies. For a commodities business, it is magic. Geography provides diversification and safety. Production is split between Chile at Atacama with 35 to 40% as the cheapest source, Australia with 40 to 45% as a reliable region, and the United States with 10 to 15% as a strategic asset. Sales are diversified across China at 36.5%, South Korea at 17%, the United States at 16.8%, and Japan at 10.9%. The risk of dependence on a single country is minimal. Catalyst number 1. The lithium deficit is returning faster than expected. The current situation, as of December 2025, is that prices rose from $8,259 sign in June to $13,003 sign in December, which is plus 57% over 5 months. But this is only the beginning. Albemarle S forecast for 2030 says demand will reach 3.7 million tons of lithium carbonate equivalent, which is plus 15% versus previous forecasts. Supply is expected to reach only 2.9 million tons of lithium carbonate equivalent. This implies a deficit of 800,000 tons even after accounting for recycling. Supply is lagging because new hard rock projects take up to 10 years to launch. Integrated projects take around 14 years. And to cover demand, the market would need more than 100 new projects at prices above $20 sign per kilogram. The problem is that the world cannot build 100 mines in 5 years. This is physically impossible. Catalyst number 2. Competitors are weakening. While Albemarle was cutting costs, competitors were giving up. Mineral Resources in Australia saw Mount Marion down by minus 21%, and Bald Hill was shut down. CATL in China closed the Jianxiawo mine, which removed 3% of global supply. Ganfeng Lithium postponed capacity expansion. The result is that when demand returns, there will be no one able to satisfy it because restarting a mine takes 6 to 12 months. Albemarle will capture all incremental demand. Catalyst number 3. Geopolitics is working in Albemarle's favor. China controls 64% of lithium processing. And in October 2025, China introduced export restrictions. The response from the United States includes the Inflation Reduction Act, which provides subsidies only for batteries from the United States or allies, and the CHIPS Act, which stimulates the extraction of critical minerals. Lithium is now a strategic resource. Albemarle is the only large American lithium producer. Its United States projects include Silver Peak in Nevada, expected to double to 10,000 to 20,000 tons by 2025, Kings Mountain in North Carolina with a launch in 2027 to 2028, and capacity of 50,000 tons per year, and South Carolina currently frozen with potential of 100,000 tons per year. Tesla, General Motors, and Ford need American lithium, and Albemarle is the only option. Catalyst number 4, technological barriers protect lithium. The perceived threats are sodium batteries that do not require lithium, solid-state batteries that use less lithium, and hydrogen as an alternative. The reality is that sodium batteries have energy density of 150 watt-hours per kilogram versus lithium at 250 to 300 watt-hours per kilogram, which limits them to cheap city cars. They will not replace lithium in the premium segment. Solid-state batteries are still lithium-based. Mass production is not expected before 2030, and costs are 3 to 5 times higher. Hydrogen lacks infrastructure and has efficiency of 25 to 35% versus 85 to 90% for electric vehicles. The conclusion is that lithium will dominate at least until 2035 to 2040. Catalyst number 5, China as an unexpected ally. In October 2025, 51.6% of all cars in China were electric, more than half. China's plan for 2027 includes doubling charging capacity to 180 gigawatts, subsidies for electric vehicles, and new factories from CATL, BYD, and Ganfeng. Ganfeng forecasts 30% demand growth in 2026. For Albemarle, 36.5% of sales go to China. Contracts exist with CATL and BYD, and volume growth is effectively guaranteed. Financial logic, valuation versus potential. As of December 2025, Albemarle trades at $140.48 sign, with a market capitalization of approximately $16.5 billion sign and cash reserves of $737 million sign. Analyst target prices include UBS at $185 sign, RBC Capital at $159 sign, Citigroup at $150 sign, Morgan Stanley at $147 sign, Mizuho at $132 sign, and Deutsche Bank at $125 sign. The weighted average target is $152 sign, which implies plus 8% upside. But this estimate remains conservative. Scenario 1, conservative. Cyclical recovery from 2026 to 2027. Assumptions include a lithium price of $18,000 to $20,000 sign per ton by the end of 2026, production volumes of 200,000 tons per year lithium carbonate equivalent, and a EBITDA margin of 25 to 28%. Financial results for 2027 imply revenue of $7.5 to $8 billion sign, EBITDA of $1.9 to $2.2 billion sign, and earnings per share of $10 to $12 sign. Valuation assumes a price to earnings multiple of 15 to 18 times, which implies a target price of $150 to $216 sign. Upside potential ranges from plus 7 to plus 54%, with return on investment over 2 years of 4 to 27% annually. Scenario 2, base case, moderate deficit from 2027 to 2029. Assumptions include a lithium price of $22,000 to $25,000 sign per ton by 2028. Production volumes of 250,000 tons per year with Kings Mountain launched, an EBITDA margin of 30 to 35%. Financial results for 2028 imply revenue of $10 to $11 billion sign, EBITDA of $3 to $3.8 billion sign, and earnings per share of $16 to $20 sign. Valuation at 15 to 18 times earnings implies a target price of $240 to $360 sign. Upside potential is plus 71 to plus 156%, with return on investment of 17 to 35% annually over 3 to 4 years. Scenario 3, bullish, critical deficit from 2028 to 2030. Assumptions include a lithium price of $28,000 to $32,000 sign per ton by 2030. Production volumes above 300,000 tons per year with all projects launched, and EBITDA margin of 38 to 42%. The market revalues Albemarle as a growth company. Financial results for 2030 imply revenue of $14 to $16 billion sign, EBITDA of $5.3 to $6.7 billion sign, and earnings per share of $29 to $37 sign. Valuation at 18 to 22 times earnings implies a target price of $500, $22 to $814 sign. Upside potential ranges from plus 272 to plus 480%, with return on investment of 30 to 42% annually over 5 years. Risks, an honest discussion. Short-term risks over 1 to 2 years include lithium price volatility. As prices fell from $77,000 sign in 2022 to $8,000 sign in 2025, which is minus 89%. Probability is medium and impact is high, but Albemarle is a low-cost producer and can survive any cycle. Geopolitics and tariffs are another risk, as 36.5% of revenue comes from China. Probability is medium and impact is medium, mitigated by customer and geographic diversification. Technological breakthroughs, such as sodium or solid-state batteries, have low probability before 2030 and medium impact, since mass adoption takes 5 to 10 years. Long-term risks over 5 to 10 years include recycling, which could supply 30% of lithium by 2030, but demand still triples. Environmental restrictions in Chile carry medium probability and impact, mitigated by diversification into Australia, the United States, and Argentina. New competitors such as Rio Tinto, which acquired Arcadium for $6.7 billion sign, have high probability but low to medium impact, as entry barriers are high and projects take 7 to 14 years. Entry strategy: how to invest intelligently. For a long-term investor with a 5 to 10-year horizon, a phased entry is preferred. Stage 1 is now, December 2025, buying 30% of the position at $135 to $145 sign. The stock has rebounded from the bottom but remains 20 to 30% below fair value. Stage 2, in the first or second quarter of 2026, is to add 30% if the price falls to $115 to $125 sign due to cautious guidance. Stage 3 in the third or fourth quarter of 2026 is to add 40% if the price drops below $100 sign, which is unlikely but represents the optimal entry point. An aggressive alternative is to enter 100% immediately at $135 to $145 sign. Key items to monitor include quarterly reports with production volumes, EBITDA margin, and free cash flow, lithium spot prices from Shanghai Metals Market, global electric vehicle sales, and the Kings Mountain launch. Final verdict: Albemarle is not just a commodity company. It is a ticket to the energy revolution. The recommendation is to buy in stages with 30% now at $135 to $145 sign 30%. On a correction to $115 to $125 sign and 40% if the price falls below $100 sign. The base case target price is $240 to $360 sign by 2028, implying expected returns of 17 to 35% annually. The most important point is that we are at maximum pessimism. Lithium prices are down 89%, competitors are failing, and analysts are writing obituaries. At the same time, Tesla is building 10 new gigafactories, China is doubling battery production, and Kings Mountain is approaching peak capacity. History shows that the biggest money is made when you buy what everyone else is afraid to touch. The question is not whether Albemarle will grow. The question is whether you have the patience to wait until the crowd understands it. Warning: this is an analytical review, not financial advice. All investments carry risk. Conduct your own research and consult a licensed financial advisor before making investment decisions.